and grade stocks and exchange-traded funds.
I might have gotten cut off a little bit there. I forgot to hit start the broadcast. So I am Mike O'Connor, and I'm the architect of stock cheat sheets at Substack.com. One of the many products we kind of incorporate into this weekly get together. Double A and I have. Double A, how is that stash is looking you're ready for winter there in Denver.
That's right. I'm considering becoming a plumber.
I was going to say a plumber or a porn star. I'm not sure which.
Or both.
Yes.
Yeah. It's early Monday morning. I'm usually not at my best game in the morning. We'll see how this goes.
Yep. But a lot to get through today.
Yeah.
To me, the week became less important. Jerome Powell moved the market, got it all out of the way, kind of blew his wad, so to speak, on Wednesday afternoon. So my sense is the data points all still matter, but I find it hard to believe that market participants would start to wind up another round of hopium as the result of individual data points. I think they laid out a very clear vision for what it's going to take. It's higher than 5%. They don't know how long it's going to last. And of course, the only thing we're not sure of is the extent to which they have conviction outside of the kind of the knowns, right? So the knowns are unemployment. They don't mind if that's going to start going up, meaning employment going down.
Not only mind, but probably prefer.
Right, prefer, absolutely. Don't mind a little GDP slippage, even a little bit more than a little. They probably don't mind the stock market going down, especially now that the election is over, or will be over by the time they impact the market again next. And housing, they really want that one to go down.
Yes, they do. Go ahead.
So I was just going to say, so it's the unknowns, I think, that are my test. If looks like, we only get 50% of the say in a war with China, right? They get the other half. And that's a known unknown. We need money to print to pay for wars. And there's several others, but that would be just an example. The other big one would be a too big to fail blowing up. A sovereign
data of some sort, yeah. Mm-hmm.
Greek, Portugal, and so Italy all blow up simultaneously. I mean, the Fed is in danger of tipping the world into the kind of recession where that is actually foreseeable.
They're attempting to execute a very delicate operation amidst a very chaotic world.
Yeah, and I would argue, Double A, that Jerome conceded that delicate is less and less likely.
He did. So I want to mention a few things, and we don't have to spend too much time on it since it's in the past, it's happened. But to me, it seemed that when Powell came out, he was walking back his own statement to some extent, which
he did.
Yeah,
First thing he did. Yeah.
Which to me it said, and obviously I'm not in the room, so I don't know, but it seems that the statement was crafted by the group. And Powell maybe appeased them a little bit by letting them craft the statement how it was crafted, but then he came out and stomped on it.
Absolutely. It was basically the Wyoming speech to Electric Boogaloo.
Exactly. Exactly. And then the other thing, actually one of the things I found most interesting from his speech, because I sat here and watched it, was near the end, and maybe it doesn't matter because I haven't seen too many people grab this point, but near the end of the speech, somebody asked him about the probability of recession, and I don't remember the words verbatim, but basically Jerome Powell said, "I don't know," which to me was surprising coming from a sitting a Fed chair to say he didn't know if there would be a recession. Because think about Bernanke, the world was crashing around him, and all he had to say was, "We're confident, subprime contained," all these things. And so I found that very curious and actually a pretty bearish statement that he conceded that he just doesn't know.
Yeah, and then he further went on to clarify because the journalists there, they're all pros. They weren't going to let him get away with the typical, Fed speak jargon.
Mm-hmm.
Basically, when pressed, and this was the issue about soft versus a more difficult recession versus a light and fluffy one. And he's, pretty much indicated he thought the chances were less and less of a light and fluffy recession. He was looking, he was pretty confident that this one was going to hurt and that the choice was hyperinflation that would be here to stay, killing the nation and the spending power of the dollar and ruining retirements, or tough on the stock market for the next 2 to 3 years. And he's definitely in that camp. I think he does grasp this. He just didn't talk about it. But the elephant in the room continues to be, now it's no longer about the debt. It's about the debt service as a percentage of the U.S. operating budget. And given the political climate, we are just, it almost is feeling a little bit like let me be really clear. I'm talking about the political climate in terms of its ability to solve big problems like bailouts and whatever has to happen, where the Congress has to work together, especially when we're about to have, I think it's pretty clear, a mixed legislative branch, and maybe completely mixed compared to the presidency, if not split down the middle. But we're in for, I don't think we have the ability to solve our problems politically. So it's all going to rest on Jerome's shoulder. And I think he's sensing that.
Yeah, I will say there's so not that I disagree with you, but also if you think back to the onset of the pandemic, it was a rather divided political atmosphere at that point.
Oh, yeah.
And that Congress seemed to come together and draft and create a rescue plan and implement it. It's somewhat encouraging. When their feet were in the fire, they kind of did something. But at the same time, I agree. It's getting more and more difficult, it seems, for them being, opposite parties work together and find solutions. I agree.
Considering one party has put on the table that they're willing to create a global financial crisis at the next debt ceiling vote. We'll have to see. But I think political is a big question mark. We'll see if we get through this without election denial on one or both sides of the aisle. Who knows? But so in political instability, check. Recession, check. And so finally, there's actually going to be something for people to bitch about. I think the last 2 years has been mostly an abstract civil war, so to speak. This will get real because now it's people going hungry, missing vacation, missing out on some of the leisure time activities that other members of society will be able to afford. And that bifurcation of the haves and have-not gets worse. So we have that. We also have analysts continuing to bring down estimates for next year, right? We're finally seeing them get real.
Right.
And I have not looked at the latest S&P forward multiple. The last time I checked, it was still around 15. It's better than it was, right? Better than 18. But still not near the single digits that is where typical recessions leave us. Right? Very rarely do we have a double-digit PE multiple on forward earnings, at the bottom of a recession.
At the backside, right.
Yeah, it's more likely 6, 7, 8.
Right. So basically, your point is the S&P has some room to give if we find ourselves in a recession.
Yeah, and listen, we've been at this 3,800 mark on the S&P for quite some time now. Is it 3,800? Yeah, 38-ish.
Yeah, it seems like a pretty important mark.
It is. And so do you think, the chances of us violating that before reaching new highs seems very high to me.
I would agree with that completely. Yeah. I think, I'm of the opinion that new lows are to come. Maybe we see a rally into the year end, Santa Claus, whatever you want to call it. And I think you agree with me there that the low is probably not in.
Oh, I definitely agree. And so I think that any turnaround of inflation will probably spark an overly exuberant market reaction. But I think more and more market participants aren't going to take the bait. So I think it's going to be more of a quick up and a ruthless pound down when that happens. So you get and what I mean is not a wholesale reversal in, the consumer inflation trend, but just a little tick down, or, oh, you look at that. We
a whisper of hope.
Missed expert analyst opinions by a couple of points.
Yeah.
Woo, happy days are here again.
Right.
But I think they'll slam that down now, even more aggressively. Do you think there's an 8-week bear market rally in our future based on the current Fed rhetoric? Anyway.
At this point, I don't know. I don't want to say because there's too many things ahead of us this week.
There's so many things.
If you asked me that same question on Saturday, I'd probably have a more definitive answer. But this week with the election and then with the CPI report, I think everything hangs on CPI report this week.
Yeah. Do you think the elections market moving? I guess it
Minimally.
is if there's something horrible, God forbid, something horrible in the way of political violence happens where there's, instability in the country.
Yeah.
That would be an issue. But otherwise, I think it's baked into the cake. Pretty much market participants believe divided government is coming and we're moving on. I think the next Fed meeting is absolutely critical, but it's been diluted a little bit because of, as you mentioned at the outset here, Jerome just let us have it, right? He was double-barreled shotgun. And so I don't know if the market gets overly encouraged by, one data point or two. I think the reality should be sinking into more participants. I'm not saying everyone. I still think there'll be a rally on any surprise, especially meaning a bad news is good news. I think we're still in that world.
Yeah. The buy the dippers the more the buy the dipper gets stepped on, the less likely they are to buy the dip. Yeah.
A bug can only get squished once. And these bugs have been gotten their fair share of shoe leather here in the last 3 months. But it's amazing. The more we do that, and I realize we're talking to a group that's listening to the Macro Monkeys podcast, which we should say hello. Thank you for listening to Macro Monkeys.
Right,
thank you for subscribing to Cheat Sheets at .substack.com. And thank you for being a Shake and Power user. Those are our three groups that we bring together for this weekly meeting.
Yeah. So Thursday will be that CPI report, and that will be a market moving event.
And prior to that, we get a little heads up. When is the producer price index? Is that tomorrow?
Let me look.
I got it here.
Okay.
Actually, you know what? Let me share my screen. I'll put the thank you CBS Market Watch, by the way, for providing the underlying data.
That's right. I'm looking. I don't see.
Maybe PPI. Was it last week? I don't think so.
Well, there's wholesale inventories on Wednesday.
That's not quite it.
Mm-mm.
Yeah. Let me get our screen up. Tell me when you can see us.
Okay.
Because I've got the vortex.
There you go. There you go.
So we have. I'm already fast forwarded to. We get the election. That might be why the PPI isn't that day. All core consumer Thursday, but we do have some bit of Fed speak, don't we? New York, Cleveland, Richmond. Boy, there's 4 or 5 of them. Philly.
And I'm wondering if the other Fed members that are on the FOMC are going to come out and try to undo some of what Jerome said. These guys are a chorus of yo-yos.
That could be, but the market. I'm actually surprised there wasn't more downside follow through. Now we got a little, right? I can't remember. We actually closed the week on a bit of a rally, didn't we? But it was after a punishing Thursday, if I remember correctly.
Yes.
So we had Wednesday, a shitty close, and then Thursday, bad market day. And then Friday, we started bad, but I think we ended better, if I remember correctly.
That's right. Friday ended higher. Mm-hmm.
And then today, as we record this, just about ready to get into the open. I know that those of you who are looking at my screen, you just remember this is going to be pre-market data. And it looks like we're going to start about, at least the futures are about 13 points up. And there it is, kind of a bounce off that bottom, so to speak. And of course, with indexes going this long, it's not going to be an exact area. But it's right about this I guess I got it at 3,700, but it's there 37, 3,800.
Yeah, we've been dancing around 3,800.
Yeah, and this line keeps moving, kind of slips down, right? Mm-hmm. Each time we put in a new low, we just don't break it. It's the weirdest bottom. If we're bottoming, it's the weirdest bottom I've ever seen. That's why I don't think we're bottoming.
Yeah. What do you think about the movement or lack of movement in the VIX and volatility? It's staying bid really. Despite whatever the broader indexes do, whether they rally, whether they fall, VIX is just kind of stuck.
I am shocked by it. I think you and I exchanged messages as Jerome was speaking and tanking the market.
Mm-hmm.
There was a tank off going on without any corresponding move higher in the VIX.
Yeah, it's very curious. And I scroll through my Twitter feed of people that discuss these things, and everybody seems to be a little perplexed by VIX, and I'm no different, and I certainly don't have the answer.
But the only thing I could say is if there's only so many market participants that are sophisticated enough to be hedging with puts or derivative spreads of some kind,
Mhm.
And so are we maybe thinking that certainly not every market participant is hedged, but those who are going to be hedged have had 9 months to do it, 10 months, they've had a invasion of Ukraine. There's talk of China declaring, or being ready for battle for the US. So the globe is, gone to hell in a handbasket. Energy prices have spiked and pulled back. Everyone's using different economic leverage. And so a lot has been thrown at the market. And we're down 33% on the NASDAQ. I think we're all so fearful of what's to come. We're sort of dismissing how bad it's been. These are pretty big pull down numbers that we've gotten here.
It's a really good point. It's a really good point. Yeah.
So part of it tells me, because the time to buy puts is when the VIX isn't going up, right?
Right.
I don't think anyone's expecting the VIX to go down that much more. There's way too many tail risks out there that could, or headwinds, that could knock us off course substantially. What are we waiting for? So is the market out of puts?
Supply chain issues on puts.
Now, the other thing I think that's going to be interesting from a macro perspective is we've gotten a taste of this because the market always anticipates, but energy as a complex, and particularly the closer you get to oil, the more this is the case, has been just drifting higher for the last few weeks.
Well, that's something I noticed is that there seems to be at least a little bit of a disconnect between crude, the underlying commodity, and some of the oil stocks, right? Or most of the oil stocks, where crude has just been drifting in a pretty tight range.
Yep.
And yet XOP looks like it's about ready to leave the atmosphere.
Well, I think that there's two groups of traders, right? There's ones that are dealing with front month contracts, right? So I'm not now talking not about the hedgers, but about the speculators here.
Mm-hmm.
And so there's those two groups, but the hedgers. What are we in contango or backwardation? Do you happen to know if the more you go out in price, crude gets more expensive, doesn't it?
On oil? Yeah. Let me just double check
so.
here.
I mean, I think it's typical.
Yeah.
We do not have a spot month spike issue right now.
No.
So if you think about it, I think in general, the market expectation is much higher energy prices. And therefore, those who are in a position to hold you don't hold crude for, years on end, right? When you're holding that front month or back month contract, you're thinking about the next 60 days.
I'm looking at the back month. I'm looking at the January contract, and it's about where we are.
Got it. Okay. So maybe in a little bit of backwardation.
Yeah, it's pretty close.
The spot price is driving. I just don't know.
Yeah. Okay.
This is not my specialty, but my point is that there's a reason. I think energy companies can drift higher because earnings are going to be delayed based on rising crude prices. So we've had a pretty decent move in crude in the last 10 trading days. If you think about it, we're moved from, roughly 82 just before Halloween to now we're in the low 90s. So not an insignificant move in crude the last 10 trading days. And there's a lot of catalysts in the future. The U.S. Petroleum Reserve debacle is going to come to an end, and we won't be flooding the markets with crude. Saudi Arabia clearly breaking away from the U.S. and in a cabal with Russia now to control energy prices in the favor of producers. The U.S. policy not willing to change. We're not making it easy for those responsible for CapEx and the drilling and exploration community to do exactly that here in the U.S., right? It's a big push to move us to fossil fuels. So there are some drags on the crude supply here in the long run, and that's going to favor energy companies.
It's a really good point. It does seem that the long established energy complex, if you will, around the world is changing. Like before our very eyes is changing.
It is. And let's not forget that there's going to be a whole lot of government funding money around solar. So TAN ETF, while it definitely had a big double top and a downtrend over the summer and early fall, it's double bottomed at around 65 and it's back up to 73. It's up, about 10%?
Yeah, and TAN ETF, for those not viewing TAN, the TAN ETF is solar, right? It's made up of solar companies.
And that ETF actually looks pretty good from there's mixed signals on it for the long-term market outlook, which is expressed by a proprietary indicator that we use called and those of you who subscribe to cheat sheets are familiar with it. It's a long-term technical metric that speaks to the likelihood that at the end of 9 months-ish, we would be higher than we are now. That one's actually kind of, that's been moving and kind of in concert with the recent downtrend. So it hasn't turned yet. And it's going to take a bit of more of a move in TAN to do that. But the intermediate time frame, we've actually moved in a intermediate trend progression from mildly bullish, which I like to call neutral plus, to more substantially bullish with an intermediate oscillator crossing above its sort of Rubicon, which is the 50 level. Oscillators are on a 0 to 100 scale. And so below 50 is more bearish and above 50 is more bullish. Direction of the indicator matters, and we're above 50 and rolling up. That said, doesn't appear that we've got any kind of impending short-term pressure on crude, at least based on the oscillators, or I'm sorry, on solar, based on the oscillators. I think the news is here. I don't think TAN is waiting for a redder or bluer Congress to get elected. I think that's all baked into the cake. So it's going to be, the rollout, right? The government execution of their plan to incentivize consumers and businesses to solarize. But energy looks to me like about the only good, that's the only really bullish sector out there right now.
I have to agree. I mean, personally, energy is the only thing I have any bullish position in at the moment.
Yeah. And, there's some financials trying, there's a move in the XLF that I think was interesting over the weekend, and the idea that energy, bank stocks, as interest rates go higher, will make more. So XLF's kind of broken out of a tight diagonal trading range here and may have done what we call a throwback retest. We won't know until we know. But those breakdown signals we got mid-Jerome speech last Wednesday seem to have been negated by subsequent momentum, which is actually turning the prospects for long-term and intermediate-term trend progression higher. And we have a nice little bounce here. And this one doesn't look like a bad. I think it's a good B- opportunity in these market conditions.
Interesting. I noticed also Staples. Was it Staples or was it Utilities? I noticed yesterday.
Let me go there next. I just wanted to follow this up by showing KIE. It's probably the strongest financial, which is insurance.
Insurance, right?
Insurance. Yep. That's broken out of a fairly significant resistance, thrown back and retest successfully. And that one looks like it could be off to the races. Or at least back up another $2.
Okay.
So it's either off to the races or it'll be hit its head in resistance.
Or back to the stable. Yeah.
And then XLP, you were saying?
Yeah, I can't recall. I was preparing yesterday and I've since forgotten. XLP or XLU, I forget which one looks like. There you go. XLP had a little bit of a pretty decent rally there.
Yeah, I agree with that. Let me get rid of this drawing for those of you who are watching on. We're still channeling lower, after a topping pattern. A little bit of a head and shoulders reversal, but it failed, didn't it?
Yeah.
The neckline, which is what you need, you get a breached neckline and a head and shoulders, and that failed. And what do we always say about failed breakdowns, AA?
They when they reverse, they tend to reverse a little harder.
Yep. And this is a weekly chart for those of you watching at home, meaning watching on a screen. We're still within diagonal resistance, so the next move is going to be a break above 74-ish. And if that happens, then I think we're insurance, or this is XLP.
Yeah,
that looks like it's poised to run a little more. So I actually have some relative strength charts if you want to see, and that way we can focus on the top sectors.
Yeah, real quick, but we'll just wrap up the macro monkeys and we'll move on because I know we're on a timeline today. Just had one final thought for you. What do you think of the narrative? And I've read this a little bit in different places that value is the new growth. So yield is the new, explosive tech company. What do you think of that notion? Well,
I would totally agree with that. In fact, if you can see my screen, I've got some data to share with you that will sort of make the point. Now, what I would say is my conclusion is that value is absolutely safer and maybe rotating into a place where it's actually going to be more profitable. But what you see right now is the number of growth-oriented ETFs that have really bad money flow numbers, like in the negative 0.3 and lower camp.
Mm-hmm.
And what you'll see is that there's several that are enjoying, higher relative strength along with value plays, but the upside implied by money flow is nothing like the downside implied by money flow. I just happened to send this out to my subscribers this week. It was a paywalled, so this was a chance for us to, at least on this video, make it free. But I came down here. I can't believe we didn't talk about this, but
I saw this yesterday. Yeah, I saw it.
Right now, value has been the top of the food chain forever, right? Ever since the market topped last year, there was a rotation into value, but really nothing has done that well, right? You've got, even now, value overall, the SPY value, which is the Chaikin large cap value, that's kind of underwater, right? Negative 0.1 plus money flow, slight short-term uptrend right now. So at least compared to growth, there's at least some trending going on. There's nothing happening with growth.
Less bad.
Yeah, less bad. And now let me show you. I've got the two charts we can put side by side here. So here's this is the SPY G chart. And this, for those of you, I think macro monkeys, you're basically seeing a receding growth chart, basically.
Okay.
And it's SPYG.
Which is, what is SPYG?
Yeah, SPYG is basically growth.
Okay.
The growth side of SPY. So you have spiders, and you have SPYG and SPYV. So V will focus on value stocks. Maybe you should explain what a value stock is.
A value stock is, Coca-Cola, right? I have no idea if Coca-Cola is included in the SPYV, but it would be an example of a value stock.
Totally agree with that.
Yeah.
It's basically the growth opportunity is no longer the single driving factor, right? Value stocks generally have lower PE multiples, higher dividends. They're not having to take the cash flow they generate and pour it into building more plants and hiring more staff. They've kind of reached stasis. They certainly compete for market share in whatever they do. And it's not like they don't spend money, but the whole orientation of the stock market and the way it gets traded more like a Warren Buffett stock.
Got it. Yep.
So it's about valuations and earnings and free cash flow and all those good metrics. It's not about like the Jeff Bezos model growing Amazon, which is we'll see in 20 years, that's when we'll turn a profit. Every dollar we make is going back into building our empire. But we're starting to see a bit of a turn, AA, and that's what I was going to say. And it's a little hard to see it here because both ETFs, I think you'd admit, are trending down, right? Correct. As you look at this.
Yep.
But you'll notice that one of them recently has a much more explosive sort of move. And this I would say began here in, let's call this late August, early September, maybe early October. There's a little double bottom in value, but growth is still kind of tracking down. Here's probably the most significant metric this is the relative strength. What I'm pointing to is on the charts, a oscillator that shows a relative price comparison in both the 3-month and the 6-month look-back period. And you'll see that the growth had been underperforming value early in September, and then we sort of kind of got to parity for a little while. So now here we go again, another kind of move lower in terms of relative strength for the growth and higher for value. You can see there was a run where value is outperforming growth, and you see that, right?
Yeah.
Well, what do you also see?
It's also declining. Maybe.
Declining, right?
Yeah.
So unlike the recession in 2000, where the stock market in the first year, the Qs, which is probably the best example of growth, that was down a little. It was just under 30% in the first year. Meanwhile, value was up 16%. So there was a complete bifurcation. We haven't seen that yet. Basically, growth underperformed, value outperformed growth, but both went down. You see that, right? Green lights, but going down.
And just to be clear, for those that aren't watching, or maybe that are, just to be clear, you're comparing them when you say relative strength, relative to each other.
Correct. It's the price performance. When you look back 3 months and you look at the price difference in one stock versus the other, we call one that's doing better outperforming. And we just simply divide the price 6 months or 3 months ago into the price today. We get that ratio, and then we can tell which one has a more favorable price appreciation ratio.
Cool. Thanks. I just want to be clear about that. Thanks.
It's called relative strength, and it's probably the most important way to anticipate what institutions are doing out there, which is why I place such a value in it with the cheat sheet subscribers, because you often will see that those relative price dynamics change before price on an absolute basis changes. Does that make sense?
It does. The other thing I've recently become a big fan of using is volume as an indicator,
Volume confirms it.
Yeah, absolutely. And I see that on the bottom chart, the values chart, that there's been a little volume as of late. There was one particular day. Yep.
There's much bigger volume days on the value side than the growth side. That's absolutely true.
Yep.
So obviously we've got a big diagonal resistance to take care of, but the fact is that in the intermediate, this isn't even short term here. This is several weeks that we're looking at here on the far right hand side of the chart, where I'm pointing is we've got this explosive move in relative strength, along with an explosive move in price, especially relative to growth that is actually going the other way, right? We're going down. We're going flat on growth. We're going up in value. So, but here's the money shot. So what I took was all of the ETFs that have reasonable expense ratio. Some growth and value ETFs have managers assigned to them, so they're trying to beat the market, and so their expense fees are a little higher. So I capped the ETF expense at 50.50%. That's the highest management fee I would accept. And just to give you an idea, the Vanguard Total Market Passive Index ETF, stock, what do you call it? Mutual fund?
Yeah.
It's been so long since I've been in a mutual fund, but that one's managed at a 0.1 ratio. So while 0.5 is 5 times that, for a managed fund, I think it's a pretty good deal, right? Anything 0.5 or lower, we consider a reasonable management cost for an ETF or a stock mutual fund.
Okay.
So that's the cutoff. And then what you're looking at here on the screen, what I'm showing is a stack rank first of all the growth ETFs. Okay, so no value here. These are all the different ways that growth is managed, and so this is only basically a look at the relative performance against one another, so you could find the top tier. But what I want you to notice is over here on the right. If you were to describe to people who can't see the chart, remembering that money flow is like water pressure. It's like water in a steam engine, right? You have to heat it up first, right? And that water has to turn to steam, and the steam has to reach a pressure that will eventually cause the turbines to turn, right? And the engine will then pick up speed and the train will get going.
Right.
But it's not instant, right? There's a period of time where that pressure builds up.
Right.
So think about the opposite of that is here you're going at full tilt and suddenly the steam engine stops working and the pistons stop turning and the water pressure goes silent.
The relief valve has been opened.
You got it. I mean, if you were to look at this and eyeball this stack, and you've seen enough different stacks with with money flow scores, what would be your observation? I think there's two observations I would hope you would make. One may be less obvious than the other, but one's kind of clearing.
I think the most obvious is the fact that there's a fair amount of ETFs in the stack that have negative money flow.
Yep, absolutely, and really colossally negative money flow. We're talking about negative 0.57s and negative 0.56s. That's my criteria for rating an ETF to have bullish money flow is a positive 0.1 score. So imagine being nearly 6 times 6 times in the opposite direction, the criteria for being bullish on an that's just an unbelievable divergence to me.
So institutions, because they're who move the market.
That's right.
They're pulling money from these investments.
You got it. And then the other thing that may not stand out to you as much, but if I just remember the 5 over the 20 moving average is just a really short-term trend. But what do you see in terms of the trend for growth?
For the most part, the trends are down, meaning the moving averages are crossed in a bearish direction.
Yep. And an intermediate and longer term, we're talking, for intermediate term, we're talking weeks to a couple of months. That's a pretty short time horizon for probably most macro monkey level investors.
Yeah.
For traders who are maybe more attracted to stock cheat sheets.substack.com. The 1040 moving average might be the sweet spot, but still early for longer term investors. But it's all negative, right? So a little bit of money flow in a couple of places. Like in future innovations, we're seeing that a lot, where some institutions, I think, are taking advantage of negative price moves and sneaking into Cathie Wood style investments. I think that's probably what's driving the money flow. Institutions aren't expecting it to turn around tomorrow, but are okay putting their billions to work, here at these low levels.
They think they have an appropriate time frame.
Yep. Now, I was surprised by the number of value ETFs, and that's what I'm moving to next. For those of you listening, it's just a stack of value-based ETFs. Most of them are tagged with a V. But you'll notice, the trend in at least some of them is starting to change.
Yeah, right? Especially on the shorter term, which means it could just, as you've, I think, alluded to, that the move is just getting started. Absolutely. And you'll notice that it's much more pervasive than it is up here. And you're right about that, AA. We start with a 5/20 moving average cross, and then a 10/40, and then eventually a 10-week over 40, right? So that can take months, if not a year or two, to play out. So if value has a track record of running in a positive direction in a bear market, and we just didn't see that in this first stage where everybody sold the bathwater along with the baby. We may be starting to see a turn, and these would be the leaders here, like Zig, for example, which is what's called an acquirer's fund. These are candidates for acquisition that a particular active ETF manager has put together. And there's another one, which is the Vanguard value factor. It's not doing that great from a money flow standpoint, but it's way up here in terms of relative strength. And I'll point one out that I wrote about on last night's blog is called FAB. It's basically a multi-cap value fund of likely high performers. So it's FAB is the signal, but they're all starting to rotate into favor. And then when you stack them up against one another, we can pick those one or two out, and then from there we see there's that ETF FAB. It's got a high acquisition rating, and we won't get into all the technicals here, but you can see from a timing standpoint, we're getting those initial buy the dip signals, right? So basically, just to recap for those listening, what you've done is we've determined that value is outperforming growth, and now you've stacked value against value to find the best value.
Yep, and then on this one, we're actually stacking the best growth and value. So we're cherry picking the both and competitively stacking them against one another. Now, growth actually ends up, in terms of the upper echelon here, basically anything with a green score above 50 in my proprietary rating system. This would be the best of the best value versus growth right up here. And that's why I picked FAB as my model. And then we go one layer down from that, AA. We go down and then we say, okay, in FAB, for those of you who are Chaikin Power users, I did use Chaikin for this exercise. Let's go and find all of the very bullish stocks that are in FAB, which we already determined through the exercise I've just shown you. We stacked value against value and then value against growth, and FAB was in the top 10 of all ETFs, right? And then now this, what you're looking at, is a list of constituent components in order based on their strength in terms of institutions trading them right now. So if you'd make one global observation about this particular set of stocks, what would it be? Just stepping back from it, pretend you couldn't read even a lick of English. What color is this?
They're all green. They're all trending and in the sweet spot, as you call it.
Yep, and really bullish rating.
Right, which then boils down to your proprietary tailwind score.
Yep. And so here's what I would say. There's lots of different ways to get at the answer here. You can pay someone like me, who's got something to sell for $5 a month, or you could just go through the thought process, right? It's not that hard.
Yeah. I mean, go ahead.
Yeah. I was going to say, this is the list of stocks that are going to do well over the next year, most likely, especially if value does go into growth mode, meaning it's the one that's going to outperform large cap tech and large cap growth. Here's your bull market.
Right. And this is the kind of analysis that keeps people from, especially since there's been an influx of retail traders in the last year, 2 years, whatever. Their propensity is probably to go back to the things that they've traded before, which would be, Amazon and Facebook and Google and all these things. But this analysis is telling us that is absolutely not the place to go.
Not the place to go. And some of it is going to be skewed a little bit by what's in favor today at this moment. But a lot of it is long-term stuff like Gilead. That's not going to be, whatever the Fed does isn't going to really affect Gilead that much, right? Other than unemployment and people, more uninsured people, I suppose it will. But it's like that. You go through the list. Some of it is basically betting on future emerging technologies. Some of it is literally tech stocks. But a lot of it is energy. A lot of it is financials. It's a lot of basically what we see every day working when we get together to do our trading meeting. But the whole reason, I'm glad you asked the question that I now spent like most of our meeting on, but what it does is give you a mindset, right? Not everything has to crash in a stock market. And all you have to do is go looking by being smart about how you look for it, follow the big money, figure out what category they're trading in, find out what's working within that category, then find out what's in that instrument that's working, and then go do your own research to find the best of the best kind of within that sector or subsector of the market that a lot of institutions are focusing on.
We just took an idea, a narrative, and boiled it down to data top down in about 20 minutes.
Yep.
And using a $5 a month service that you provide.
Yeah. And again, it's a $5 a month service that will save you time, but anybody can do this.
Yeah. Yeah.
Yep. You have to find some data input sources that you trust. I happen to trust Chaikin Analytics. We use them for a very small piece of this, but a very important one, to find fundamentally higher rated stocks. And you and I have been trading together using Chaikin Analytics. And I think from a fundamental standpoint, there's no better input source that we've found for that kind of the quality rating of the company, if that makes sense.
From that perspective, I agree 100%.
Yep. And then you and I each have our own systems. And that's the last thing I wanted to do, because here I'm focusing on what's bullish in what's a bear market. And I still think the path of least resistance for a lot of stocks is lower. And that's where I think the last 6 minutes we have, I think let's focus on going through your process for identifying candidates that you can either outright short or sell call spreads against or use to hedge a long portfolio.
Yeah, and so the last week I've actually picked up a few new shorts, and while you navigate there, I'll just say that what I'm finding confirms what we just talked about, because the shorts I'm finding exist in what was previously the place to be, which is mostly technology.
Well, let's actually, if you wouldn't mind looking at your trade log and going back a few weeks, and we understand the ratings of the stock will have changed, but let's go look at a couple of your winners, because we're probably going to be able to identify structurally what they looked like at the time you traded them.
Yeah,
maybe
actually,
just give me one or two tickers that worked out for you.
If you go to my watch list in Chaikin here, I have most of them saved.
Okay, great. Let's do that. And then I'm sorry, we go into users list, and then the name of your list is?
It's either AA hold or AA watch, whichever one you prefer.
Okay. Well, which one? You tell me where the success story is going to be.
There's some in hold. There's a couple of success stories in hold. There's things I haven't quite closed out yet.
Great. All right. Well, let's even the ones that are in progress. You have a system. Let's look at them first, and then we'll go run a watch list for the benefit of people who are going to be inspired by your system to get involved with that.
Okay. Why don't we go to crowd first? It's been the most recent winner.
All right. And first of all, before we even get there, maybe explain what we're seeing just right on the surface. I mean, obviously, you're not going to trade off any of this information, but for somebody seeing Chaikin for the first time, what's this red splotch and what's that red splotch? So we're on the 6 month, by the way.
The solid red rainbow icon represents that its power gauge is bearish or very bearish. We can't tell from this view, but the red indicates that it's bearish or very bearish. And
actually, I know you can't see it from where you are. They've actually upgraded the icon AA, and they now have a little needle in that little rainbow-y thing, and it's pointed to the extreme left, meaning it, at least now, might not have been at the time, but it's now very bearish.
Okay. I did not see that. And then that other line indicates the percent that it's down.
Yep. So wow, this trade worked out. When did you put this on? Was it just recently?
No. So I actually put it on the last peak of the oscillator. So
here?
Yeah, actually
Wow.
before that. So I was actually underwater for a time in this.
Perfect. But look at that. What a great setup.
No,
Why don't you walk us through it?
it was actually the next
This one.
no, nearer in time.
This one.
Yes, yes.
Okay. Great.
So basically, it was a relative strength trigger, which is my trigger for my screen, which is where relative strength against the SPY has turned weak within the week WEEK of the scan.
Yep. So EAK, EEK, that would be right here, right? That's your triggering event, or actually, would it have been here? I'm trying to figure out.
No, it would have been the second one because it then went against me for a while.
Got it. Okay. So I just want to make sure where my arrow is pointing here in early to mid-October.
Correct.
Is so prices, and you're short, right? You're entering short.
Correct.
Okay. And I also noticed that this overbought, oversold oscillator is rolling over at this point.
Correct.
So you have relative strength turning negative. The OBOS oscillator, you probably caught it in what, about mid descent?
Yeah, somewhere just below the 70 line.
Got it. So basically, you've ridden this out, and you held with it, and you got rewarded just this morning. In fact,
yeah, Friday actually was quite a rollover.
Oh, Friday, okay,
yeah,
yep.
And money flow was there with it. I don't remember at the time if it was bearish or very bearish, but it definitely had a bearish rating on the stock.
Yep. So that's the most important thing. And this is not. You might explain to people that these technicals, for the most part, are not involved in this rating. This is all based on typical Wall Street analytical techniques, right?
Yeah, just a roll up of fundamental analysis.
Yep. And I realize you don't do a deep dive on the short side, but maybe you could point out some of the things that you think are especially telling when somebody is telling you this is a piece of shit company. What metrics do you really kind of do you say, oh my God, that they've only got this level? This is going to be a great watch list opportunity. Are there any metrics within the power gauge that are?
I make it real simple. I just look at experts because I'll let the experts, meaning insiders, do that analysis.
Yep.
And I will just take their action based on their analysis as my analysis.
So insiders are selling stock. Now, as we've explained before, insiders can sell for a lot of different reasons. Sometimes it's you just don't want to be overly concentrated in your employer's company, and so when you're in management, I did this. When I was working for a publicly traded broadcast company, we'd regularly dump our shares, not because we didn't believe in the work we were doing, or did we? But it was you just didn't want to. If you lost your job because the company's bad, you didn't want to be in both buckets.
Right.
So there's lots of reasons to diversify, but very few reasons outside of the free money they give you, right? When they give you free stock grants or options, great, I'll take those all day. But these are actually a measurement of people buying on the open market their company stock who are officers.
And it's not happening in this company, which
No, they're shorting it.
Yeah, there's a lack of conviction in future prospects. So that's
all right. So that's
really
your watch list, and then you've told us that the trigger is when relative strength goes negative, and that's where you go into action. But what else is involved?
So I look at that. I look at the money flow, which is clearly negative on this for those listening. It's a negative money flow. And I look at on the Chaikin platform, I look at the overbought, oversold to see kind of where it's been. And it looks like this last turn, it did make it above 70, which isn't ideal. I would really like to see it turn back south before 70, meaning momentum slows before the oscillator reaches the overbought status. Yeah.
Like, for example, I realize you caught this one later, but here is a stock putting in a lower high. And it's confirmed because the oscillator, I guess technically maybe it's a higher high. I'm not sure. I'm going to not count that. But basically, here was the top of the stock. Here's the high. Here's the lower high, confirming the lower high in price. And then down we go.
Yep.
So
that was my most recent find. And of course, they're not all winners. And winners
that's
like
a big
this
winner.
make
That's
up for
about
the
$40.
losers.
$40 to the downside, give or take, so far. About 25%.
So that was a good one. And there's a couple fresh ones in there. If you
where do you want to go? Netflix? I know you were talking to me about shorting Netflix.
Yeah,
that was just Friday.
Netflix is something it didn't really. I found this using a different system than the Chaikin system, because it doesn't really work on the Chaikin system. I used it. I used the market forecast tool, which you're very familiar with.
Oh yes.
Yeah.
All right. Let's stay within Chaikin. Give me one more Chaikin based short trade.
How about BURL there at the bottom? This is
right. Burlington. Is that Coates?
It is. It's a retail.
Yep, I'm familiar with it up in New England where I grew up.
Oh yeah, Vermont, I guess, right?
Yeah, that's right.
So this one I found on late last week.
Yep.
Again, same thing. Although relative strength was not the trigger. This is something I've just been watching for a long time, and been in and out of a few times this year.
You're watching it go down, yeah.
Yeah. I've traded in and out of it a few times already. And basically, this one, because I'm familiar with it and because it showed up in my scan before, I'm basically this time just trading off the oscillator.
Right here, this thing.
Yeah, which is showing slowing momentum as it turns back out of overbought.
Yep. So he basically, it's the momentum is rolling. You probably just entered this the last few days.
Friday, I believe.
Okay. So yep, you're just getting going on this one, and you're having, I think, a nice down day to kick it off. So it's perfect, good timing. And then tell me about, obviously there's a couple of things that would cause me concern. I realize that a short swing trader doesn't care about any of this because it doesn't materialize, but it's probably in the back of your head that it looks like it's done this before, where it's trying to reverse, where it's up and above its own moving average, and then the shorter time frame moving average is pointing higher. So obviously there's a risk of a bounce and a move higher, and you'd want to get out of this thing if that happens.
Yeah, I'm riding a pretty close stop on this one for that very reason, just because it's above the 200-day moving average. It's trying to move, but the money flow turning back negative gave me a little more conviction.
And then do you use a volatility-based stop in connection with this outer volatility band, or do you have a different way to get out?
I probably should, but I don't. I'm using the 200-day as a kind of the line in the sand. So
by the 200-day, you mean this double exponential moving average?
Yeah. So I'm willing to give a percentage. If I get 10% above this, then I'm out. That's a move, and I'm wrong.
Now, obviously, slightly different dynamics. That's in general. In this particular trade, you happen to enter above the 200, but it was so overextended. You're just, I'm assuming, if it gets back above your entry price plus X%, you're probably out.
That's right. Yeah, I use a percentage. Mm-hmm.
Yep. All right, so let's show people how to do the watch list. And remember, you don't necessarily have to be a subscriber to Chaikin, but if you want to take advantage of their fundamental system. So remember, one thing AA does is he doesn't even bother to look. He doesn't turn his royal eyeballs to a stock's balance sheet unless it has that bearish or worse, maybe neutral minus or worse Chaikin rating. And so that's the benefit here, is that he's not going to have a fundamental surprise, more than likely, to screw up his trade. Because remember, one of the dangers in short selling is that most of the catalysts happen during non-trading hours. And AA, maybe you could explain, I realize you use options, so this isn't a problem, but the biggest problem with stop loss, or in this case, buy stop orders, when most of the action takes place after hours, the big problem is the stop loss doesn't really matter, right?
That's right. If some announcement happens after hours, stock goes down 5%, the market, you're not trading on that market. It's after hours, so obviously you're not trading. So then you're stuck with a gap down the next morning at the beginning of trading, which may blow well past your identified stop. That's definitely a risk.
Yep. I see a lot of new traders make the mistake of thinking that their stop loss is guaranteed. And they're like, why do I want to settle for only 0.5% trade risk every time? I can clearly handle more. And I say, because every once in a while, that 0.5% trade risk is going to turn into 5% trade risk.
Yeah.
Whether you want it to or not. All right. So we go over here to screens.
Yep. Save screens.
AA bear setup.
Yep. And I will say, just to wrap up that point, Mike, there's something that I think we both do that is a little deep end of the pool, but it helps you in those situations. Is we both hedge with futures, which do trade overnight, and you can defend yourself to some extent against moves overnight. So just throwing that out there.
Yep. And I use, I think both of us also mostly use risk-defined option spreads. So we're already calculating for max loss when we're setting up our risk. So that's why one of the principal reasons, other than you can also make more bang per dollar spent in risk on the options market. But for me, it's about risk control. Yep.
Totally
All
agree.
right. So we have a neutral, bearish, or very bearish fundamental rating. And then, as AA said, the relative strength, the requirement is that within the past week, that's turned negative. That is how I enter the baseball stadium, right? Those two things.
Yep. And money flow is also weak.
Right. Got to have weak money flow.
Yep.
And so once that happens, let me go run a list and then we'll show you what you're looking for. So we got a nice juicy list here. The other thing you've done is you've already put a screener on here that filters for options and for a minimum or maximum share threshold. And in your case, it looks like you're looking for 1 million shares or more. So something optionable.
Yeah, and even then, I found that a lot of these, I'll find something I like, and I'll go to look for a trade, and they're just not.
It's not liquid enough.
So you just have to be careful of liquidity.
And in bear markets, haven't you found? I know I found this. The bid-ask spread on everything is wider, except maybe the SPY.
Yeah, it's true.
Yeah. All right. So then you have this big list, which you can save and view in your watch space, in your workspace. And you can trim this list or add other things that didn't make the cut and have a really dynamic work list constantly.
Yeah, I'll just point you to one that I know is going to work out because it's one that I have written down in front of me from yesterday's analysis, and that's snow.
Snow. Okay. Snow looks like it might be, oh, it's not what I thought it was. I thought it would be a ski resort in your neck of the woods there in Denver.
No, it's tech. It's IT services.
It is tech. All right. And this one looks attractive, but let's walk through your process.
Okay. Bearish power gauge rating.
Yep.
Check. We are below a long-term 200-day average, definitely in a downtrend.
200-day double exponential moving average, the Chaikin long-term trend. It's their proprietary indicator.
Definitely in a downtrend. And not only that, but breaking down out of a consolidation period.
That's really what I noticed here. Yeah. You put this box around it, and you'd probably go look at volume, right, to make sure there was conviction behind that.
Yeah. Yep. That's right. And then, so we have that price has fallen below the 200-day double exponential moving average. Once again, I think I mentioned that.
Yep. And following through today, which is good. Probably using the market forecast too to see if there's follow through.
I absolutely use the market forecast tool. Yep. And money flow has just turned negative. Barely so, but so. Relative strength, again, is the trigger. It's hard to see because it's just happening.
Just turned negative. Yep.
Yeah.
That's the whole idea though, right?
That is right. Trying to get this early.
That AA, we've got to stop here and mention that because I know that for cheat sheet subscribers, we beat the horse and he was already passed away and we beat him some more. May he rest in peace. Today, we do it in a lot of cheat sheet meetings, but what have I said? Relative strength moves first.
Yeah.
Perfect example. Relative strength turned negative. It crossed that Rubicon and then look what happened. Price followed.
Yep. It's absolutely right. The only thing I don't like about this, and then your point at the bottom there, which is the history of the power gauge, which as we mentioned is currently bearish.
Yep. Yeah, it's transitioned to, which is even nicer. It's on the way down. It's
yeah. So the oscillator is the one thing I wish the oscillator had a little different position. So I may wait on this one.
You didn't enter it yet.
I did not. I found this via a screen yesterday.
Yep, got it. No, it makes sense because the oscillator means that there's likely going to be some mean reversion, but that to me is just as juicy, if not more juicy.
Yeah, maybe a throwback retest of that consolidation period, which it just broke out of.
Yep. So we just drew this line here just underneath, what did you call that? About 148, something like that.
Mm-hmm.
And so what we would wait is let this exhaust itself. Now it could just keep crashing. That's the downside of bear markets is you don't get the throwback retest with the same frequency as you get with bull markets. Have you noticed that? It's harder to wait for the throwback.
Mm-hmm.
Yep. So you don't get that as much, which is why typically we traders will dive in on a follow through day. AA didn't do that because the oscillator was already moving lower when he found this one. My guess is had you gotten in the day of the down candle, you might have held your nose and considered it.
Yeah. Had I found this Thursday or Friday, I probably would have initiated a
right.
position. Mm-hmm. Yeah.
All right. And so then besides the reversal out, do you ever do a price target?
I don't. I basically just, I'll just let them run. I'll set trailing stops.
Trailing stop. So basically it's a trend trade just in a really tight time frame.
Yeah. Yeah.
Yep.
I know I do things probably a little differently, but that's kind of the system I've crafted.
Hey man, there's only one system that matters. It's the one that delivers profits.
Yeah, that's true.
That's right. Especially if it's consistent and repeatable and not the product of inconsistency. Well, we've certainly covered a lot today. You put these Macro Monkey podcasts out weekly. I'm a guest many of the days. Where do I find that?
Wherever you get podcasts, just search for Macro Monkeys. And if you like, subscribe, and listen, that would be fantastic.
Yep. And by the way, we don't say this enough because I haven't really focused yet on this YouTube channel, which is going to end up rolling to cheat sheets. But every time that you give me a like or subscribe, it helps gets the word out about this. And I promise you that if this audience grows beyond the 4 or 5 people I've got and I apologize if you are a YouTube subscriber, I've totally ignored you. It has been on purpose. I'm sorry to say it's just about time management. Please come over to stockcheatsheets.substack.com. Let me take care of you with a free, almost daily, sometimes multiple times a day, depending on what's going on, market brief. It's free. 75% of the information I give away, it's free. I save some really hardcore analysis like we just walked you through for our paying subscribers. And I really appreciate the support. It's really motivational. You know, I was working midnight last night, and while I was working, cha-ching, a paid subscriber came through. And it's just, you know, it's not about the money because it's $5 a month, $50 a year. It's about the gratification of knowing that the work you're doing mattered at least to somebody enough to where they'd part with some cash. So it's a good feeling, and I appreciate the rewards. But come on and get better at a really cheap cost because it doesn't beat free. And finally, those of you who've been with us on Shaken Power User, yeah, YouTube shut our channel down. And still, we think a fat-fingered error. We did get a little heated during the election, but this is claiming the shutdown was for something completely different. So we've just abandoned that channel, but we still love Shaken Analytics product, and you can subscribe by going directly to shakenanalytics.com.
And Mike, I got to say the drill down we did, or that you did, on value versus growth was it was pretty impressive how you boiled all that down. So props to you for that.
Well, thank you. And I think that's a mindset that you and I have had, and sometimes it just takes a lot to get that out of your brain. So I appreciate that.
Yeah, cool.
All right. Well, we'll talk to you in a week, and good luck with your shorts. Hopefully they won't impact my bullish picks, and happy trading, everybody.
We'll talk to you next week, and we'll see what CPI comes in at.
Oh, that's right. That's going to be a good one. All right. Double A, I'm going to run, so I will talk to you later on. I'll send you this recording by the end of the business day.
Thank you, Mike. Talk to you later.
See you. Bye.